The ability to read financial statements is an incredibly valuable skill, not just for accountants or business people, but for everyone who has even a passing interest in how businesses work. And the good news is that it's not difficult to read financial statements. In fact, reading financial statements is actually quite simple, and once you know the tricks, financial statements will never again seem mysterious or intimidating. The first and most important things to know are that there are only three basic types of financial statements. Each type of financial statement answers three straightforward questions, and the different types of financial statements relate to each other in very clear, obvious ways. Here's what all that looks like. This is just an overview, but notice that there are three basic types of financial statements. Each type of financial statement answers three straightforward questions, and the different types of financial statements relate to each other in very clear, obvious ways. In just a moment, we'll delve into each of the three types of financial statements and explain what information they include, what that information means, and ways a business person can use and interpret that information. The first type of financial statements are called income statements, or profit and loss statements, or just P&Ls. The three questions these statements answer are: how much did we sell? What were our expenses? And how much was left over? In other words, how much did we earn? And it's worth noting at this point that there are two basic types of expenses a business might incur: fixed and variable. Fixed expenses, not surprisingly, remain the same no matter how much or how little a business sells. An example of a fixed expense might be the rent a Starbucks pays for a store. A Starbucks store owes rent even if it never sells a single latte. Variable expenses, on the other hand, depend on the amount of goods or services a business sells. So, Starbucks has variable expenses for each latte it sells that would include, for example, the coffee, the milk, and the cup the latte comes in. Income statements are commonly used in the budgeting process, both for planning and for control. In the planning context, an income statement might be used for benchmarking. In other words, comparing how the revenue a particular Starbucks store produces stacks up to the industry average for all coffee stores in general, or for coffee stores in a particular region. The income statement might also be used by management to analyze key performance metrics, such as how much revenue the store produces per square foot of space it uses, or how much revenue the store produces per employee. Finally, income statements are used to compare the difference between a business's projected income or expenses and its actual income or expenses. And later, we'll also see a very simple trick that can be used to turn any income statement into an incredibly powerful analytic tool. But for now, let's move on to the second type of financial statement. The second type of financial statement is the statement of cash flows. This statement is extremely important for tracking where a business's cash came from and where it went to. The three questions this statement answers are: where did our cash come from? How did we spend our cash? And how much cash is left over? It's pretty obvious that a business can produce cash from selling goods or services and can use cash for buying supplies it needs to make goods or produce services. That type of buying and selling is referred to as operational activities. Interestingly, however, there are two other types of activities through which a business might produce or spend cash. Those are investment activities, such as buying or selling stock in the business itself or in a completely separate business, and financing activities, such as borrowing money or paying back some or all of a loan. Finally, if there's any money left over after a business has tallied up its inflows of cash and its expenditures of cash, the business might choose to distribute some or all of the leftover profit in the form of dividends paid to its shareholders. So, statements of cash flows can track cash receipts and cash disbursements, explain changes in cash position, provide information about a company's liquidity, how much cash it has on hand, and, as we'll see in just a few moments, to bridge balance sheets from two consecutive periods. Hang on, because we're on the home stretch now. The final type of financial statement is the balance sheet. The three questions the balance sheet answers are: what does the business own, called assets? What does the business owe, called liabilities? And how much is the business worth? Whatever is left over after what a business owes is subtracted from the value of what it owns is referred to as equity or shareholders' equity, because ultimately, whatever value exists in a company is owned by its shareholders in proportion to the fraction of the business's stock they own. It's also worth noting a couple other points. First, what a business owns can be made up of many things, such as inventory, which could be raw materials, goods in process, or finished goods, property, plant, and equipment, such as a factory, and intangibles, such as patents or the value of a well-known brand. When a business owns assets like a forklift or a factory machine that will last for several years, the balance sheet will reflect depreciation, the notion that some part of the value is used up each year as the asset wears out and must ultimately be replaced. Finally, balance sheets are typically broken down into short-term and long-term assets and liabilities. The only difference between the two categories is whether they are used or paid for within a year, or if they get used or paid for in more than a year. We're almost ready to see how the three types of financial statements fit together, but there's one more interesting point to look at before we do. Income statements and statements of cash flows both refer to periods: a year, a financial quarter, a month, or even a week. It's as if they were a movie. A balance sheet, on the other hand, relates to a single fixed moment in time, such as December 31st, 2012. It's as if it were a snapshot. For that reason, an annual statement of cash flows could explain, it could bridge the change in a company's cash position from a balance sheet at the end of one year to the balance sheet at the end of the next year. Now we're ready to put the whole thing together. The first question the statement of cash flows answers is where our cash came from. And one of the places cash may have come from is the profits, the earnings a business made by selling goods or services. The first question the balance sheet answers is how much a business owns. And one of the assets a business has is cash. And we know how much cash a business has from the statement of cash flows. Believe it or not, that's the whole deal. Three basic types of financial statements. Each type of financial statement answers three straightforward questions, and the different types of financial statements relate to each other in very clear, obvious ways. Now, let's bring this all down to earth and see what it looks like in the real world. My web browser is currently on the page where this video lives. I'm going to the address bar and entering finance.google.com. Google Finance is a wonderfully powerful free resource, and as soon as that site's open, you'll see that there's a ton of information. But for now, we'll just look at information for a single company. In the Search Finance window, I'll enter Starbucks. I could have selected any public company. Once the Starbucks page opens, you'll see again that there's a ton of information, including, for example, lots of interactive information about stock prices, about key metrics for related companies, and much more. But for now, we'll focus up here in the corner on financials. When the page for Starbucks Financials opens, you'll see that there are links for income statements, statements of cash flows, and the balance sheet. And you'll see that you can select quarterly information or annual information. For now, though, we'll look at the annual information. On the income statement, just as we learned, there's an entry for revenue, an entry for operating expenses, and an entry for net income. Admittedly, there's a lot of other information, but the three questions we expected to find are just where we thought they'd be. Let's move on to the statement of cash flows. Here, just as we anticipated, there are entries for cash from operating activities, cash from investing activities, and cash from financing activities. The numbers in black refer to cash coming in. The numbers in red refer to cash going out. Finally, let's move to the balance sheet. Here, just as we anticipated, there's an entry for assets, an entry for liabilities, and an entry for equity. Voila! Income statements, statements of cash flows, and balance sheets. Try it for yourself. It's kind of fun. And now, just for fun, watch one really neat way that some simple arithmetic can be used to turn an income statement into an extremely powerful analytic tool. What you're looking at is a simplified income statement for an actual public company. And frankly, even to a business professional, these numbers don't mean very much. But here's the trick. If we simply consider each year's revenue, literally the top line of the income statement, as 100%, and then express all the other items on the income statement as a percentage of revenue, the picture becomes much, much clearer. Notice, for example, how this company's selling, general, and administrative costs were going down year after year, while its operating income was going up year after year. This really neat trick is called common sizing, and it can be used in several important ways. For example, it can be used to compare one company to another company, look at trends in a single company over time, compare one financial period to another period, even, for example, comparing a month to a year, and comparing companies using different currencies, for example, yen, euros, and dollars. Now you know all you need to know about financial statements to decode them and to begin making some sense out of what all the numbers mean. Obviously, there's a lot of detail beyond what we've covered. And financial statements typically include tons of footnotes. And as with many things, the devil's in the details, and you really have to analyze those footnotes to understand a company's full financial picture. But for now, you're on your way to financial literacy, and the more times you try this skill, the easier it gets. Good luck!